All right, let's dive into a really fascinating story from the world of finance. It's about a company that took a look at its most successful product, a runaway success, and then decided to build a direct competitor to it.
So, right off the bat, you've got to ask, why? On the surface, this move makes absolutely zero sense. That's like the first rule of business, right? Don't cannibalize your own sales. So why on earth would a financial giant like State Street decide to clone its own flagship product? Well, the answer is a total masterclass in psychology. So, this whole story really boils down to two ETFs. In one corner, you have SPY, the undisputed heavyweight champion of the ETF world. And in the other corner, you have its new, way cheaper sibling, SPLG. This is a story of how being the absolute best can, believe it or not, create a very expensive problem. To really get this, you've got to understand just how dominant SPY is. This wasn't just an ETF. It was the first ETF ever listed in the US. It's more than a product, it's practically a piece of financial infrastructure. This is the behemoth that hedge funds and pension funds use to move billions of dollars every single day. And this slide right here gets to the absolute heart of the matter. You see, academic finance theory says the price of one share is totally irrelevant. Your economic exposure is exactly the same. But here's the thing, we're not robots. State Street knew that the sticker price on an asset completely changes how we feel about it, and more importantly, whether we think it's for people like us. So in a weird twist, SPY's incredible success actually became its biggest weakness. As the market grew and grew over the years, so did SPY's share price. It blew past $400, then $500. Without even trying, it was building this psychological wall around itself, basically telling new investors, you're not welcome here. And here you can see the two completely different worlds. For a giant institution that's moving, say, $500 million, who cares about the share price? They just need to know they can get in and out instantly. They care about liquidity. But for a regular person looking to invest a few $1,000s, a $500 ticket size for one share, that's a massive barrier. And this created a really practical problem for people called cash drag. Just think about it. Let's say you've saved up $1,000 to invest. With SPY, you could buy one single share, and almost half of your money, hundreds of dollars, is just sitting there on the sidelines doing nothing. It's just super inefficient. So what was State Street's solution? Well, this is where they got really clever. They basically turned from finance to psychology. They decided to weaponize a very well-known cognitive bias to unlock the entire retail market. It's called unit bias. It turns out we humans are just wired to want to complete things, to own whole units of something. Think about it like this. Would you rather have one giant slice of pizza or four normal-sized slices, even if it's the exact same amount of pizza? Yeah, most of us just feel more satisfied with the four whole slices. The same exact principle applies to investing.
And this quote from the source material just hits the nail on the head. That feeling of owning 100 shares of something makes an investor feel richer and more in control than owning, say, 10 shares of something more expensive, even if the total dollar amount is identical. It's a gut feeling, not a spreadsheet calculation.
So in 2020, they made their move. It was brilliant. They took an existing ETF they had, SPLG, and performed some surgery on it. They switched its underlying index to the S&P 500, creating a perfect clone of SPY. But, and this is the key, they launched it with a low, friendly price point right around $50. It was the same exact product, just in a much more attractive package. But, this was way more than just a pricing trick. That low share price, that was just the opening move in what the source material called a pincer movement, a strategy to surround and capture the retail market from every single angle. So the next battleground was the options market. Now, for a lot of the common strategies that people like to use, you have to be able to control a block of 100 shares of a stock or an ETF. And this creates a really hard mathematical barrier for most people. So get this, to use a really basic option strategy on SPY, you'd need 100 shares. At $500 a pop, that's $50,000 of capital you need to have. 50 grand! For most retail investors, that's a complete non-starter. Game over. But now look at the difference with SPLG. At around $60 a share, that same exact strategy now requires just $6,000. All of a sudden, this entire world of financial strategy that was basically off limits to everyone but the wealthy was now open for business for the average person. And they didn't stop there. They also attacked on cost. SPY was actually pretty expensive at 0.09%.
Its competitors, like Vanguard's VOO, were a lot cheaper at 0.03%. So what did State Street do? They made SPLG even cheaper, undercutting literally everyone at just 0.02%. The message here was crystal clear. SPLG is cheaper to buy, and it's cheaper to own.
This tale of the tape just lays it all out perfectly. I mean, look at every single metric: share price, expense ratio, the capital needed for options. The two products are mirror opposites of each other. They track the exact same index, but they are engineered for completely different worlds. SPY is for the institutional pros, and SPLG is custom-built from the ground up for the retail investor.
So what was the grand plan here? It was never about killing SPY, not at all. It was about perfectly dividing the market. They let the king keep his throne in the institutional world while they sent a brand new challenger to go out and conquer the retail space.
Now, I know what some of you are probably thinking. Hey, wait a minute. What about fractional shares? Can't you just buy $50 worth of SPY and call it a day? And you know what? That is the most common counter-argument, but it misses a few really crucial details.
Here's why whole shares still have a huge advantage. First up, portability. If you ever want to move your account to a new broker, a lot of the time your fractional shares can't come with you. You have to sell them, which could trigger a tax bill. Whole shares, no problem. They move easily. And second, we're right back to psychology. We just prefer to think in nice, round, whole numbers.
So at the end of the day, State Street's strategy was a home run. They ended up with two perfect products for two totally distinct audiences. SPY is still the high-speed liquidity machine for the big-time traders, while SPLG became the go-to, accessible, wealth-building vehicle for everyday folks.
And this entire playbook, this whole approach, it actually has a name. It's called behavioral financial engineering. And the key thing to understand is that they didn't win by creating a better performing asset. The assets are identical. They won by creating a better package, one that was perfectly designed for the psychology of their target audience.
And that really just leaves us with this one final thought. It's such a powerful reminder that even in the super data-driven world of finance, human behavior is often the single most important variable. It proves that how a product is presented, its wrapper and its price tag, can be just as important, if not more important, than what's actually inside.